Welcome to the Deep Dive. This is our Talk Ticker segment, and today we are taking an exhaustive look at the Q3 2025 earnings call for Intuitive Surgical, ticker ISRG.
And this was really an exceptional report. When a company like Intuitive reports numbers like these, the market doesn't just bump, it sort of recalibrates.
It totally shifts the narrative.
It does. So our mission here is to really get past the headlines and unpack why this report triggered such an overwhelmingly positive reaction. It signals something really durable.
Okay, so let's start right there with the immediate snapshot, because the numbers were, undeniably massive. Revenue came in at $2.51 billion.
Which is a 23% increase year over year. That blew past the consensus forecast of $2.41 billion.
And for a company this size, getting growth in the 20s is it's an extraordinary feat.
And the profitability metrics were right there with it. The non-GAAP earnings per share landed at $2.40.
Crushing the $1.99 consensus estimate.
Right. When you see a beat that big on both the top and bottom line, it just screams operational leverage.
Exactly. But the real engine of this business has always been procedures. And total worldwide procedures grew by 20% compared to Q3 of last year.
And that single data point changed the whole conversation. It took the focus off that, margin overhang story we've been hearing.
Oh, yeah.
And put it squarely on re-accelerating profitable growth. That procedural growth is the foundation. It feeds directly into that recurring revenue stream everyone loves.
So let's dig into that procedure engine, especially with the new Da Vinci 5 platform in the mix. The growth isn't just steady, it's actually accelerating.
That's a key point. The 20% year-over-year growth in Q3 is a noticeable uptick from the 18% we saw in the first half of 2025.
And the devil's in the details, right? Specifically utilization.
Absolutely. So Da Vinci procedures overall were up 19%. But the key efficiency metric utilization, or procedures per system, grew 4% globally.
Okay, but what's really remarkable is the U.S. utilization figure. It ticked up 2%.
Wait, just 2%? Why is a 2% uptick in the U.S. such a big deal? On the surface, that sounds pretty marginal.
It's significant because the U.S. is such a mature market. We're talking about an installed base of thousands of systems.
Oh, okay.
So moving that needle, even 2 points on a fleet that large, is a huge operational benefit. It tells customers their big capital investment is paying off. They can move more patients through the system.
It's a direct sign that the new platform is enabling some serious clinical throughput.
And that seems to be driving customer behavior. Looking at capital placements. 427 Da Vinci systems were installed in the quarter.
But the breakout is what matters here.
It is. The pull for the newest generation is just so evident. 240 of those placements were Da Vinci 5 systems.
Wow. That's intense demand. And the total installed base for the DV5 is now, over 900?
929 systems worldwide. And management made a point to link that higher mix of Da Vinci 5s in the U.S. directly to this increased utilization.
Right. They talked about the workflow efficiencies. I think they mentioned the integrated insufflation tech.
They did. It was used in almost 90% of Da Vinci 5 procedures this quarter. And for anyone listening, that just streamlines the OR. Less bulky equipment, faster turnover time.
It all just makes the surgeon's life easier and keeps the machine running.
So if that's the U.S. story, what about the international market? There's still a massive runway there.
Oh, for sure. The international story is the long-term growth driver. Outside U.S. procedures grew 24%, and utilization is accelerating up 8% in Q3.
And they called out some specific markets, right?
Yeah. India, Korea, Taiwan. They're all showing really strong traction.
So what's the big strategic takeaway from that OUS data?
It's the utilization gap. System utilization in those markets is still about 20% below the U.S. average.
So you can think of that 20% gap as just pure untapped leverage?
Exactly. It signals a long, long runway for growth in high-margin instruments and accessories internationally.
Okay, that provides some really critical context. Let's shift gears now to the Innovation Accelerators ION and the SP platform. Let's start with ION.
ION's growth was, truly explosive. Procedures grew 52% year over year.
52%.
Yeah. They're closing in on 38,000 total procedures now, and the install base is up to about 950 systems. But the fascinating part isn't just the install numbers, it's the clinical validation.
And that clinical data is just staggering. Management highlighted a study where ION, combined with a mobile cone beam CT, hit a diagnostic yield of 84.6% for these tiny lung nodules.
And to put that in perspective for you, the median size of those nodules was just 11 millimeters.
So compared to conventional methods,
Conventional bronchoscopy is only around 23%. So you're talking about a 60+ percentage point increase in accuracy for finding cancer early. That's a real-world game changer.
it really is. It drives a fundamental shift in clinical practice. And it's not just the hardware. The software is evolving too.
Correct. They got FDA clearance in Q3 for some big software updates. There's one that uses real-time AI for airway navigation.
And tomosynthesis integration.
Right, which is basically a form of 3D imaging. It just broadens the options for clinicians, which means more consistent accuracy.
Okay, and moving to the single port, or SP platform,
Yeah.
procedures there grew an enormous 91%.
91. That was driven mostly by Korea, but also early adoption in Europe and Japan, plus initial use here in the US for colorectal and thoracic procedures. It's gaining serious traction.
And while we're on innovation, we have to talk about the big differentiator for the da Vinci 5, force feedback or haptics.
Yes, they're still in a limited launch here, kind of evaluating the impact.
But they did release some encouraging early evidence. A study with data from over 400 procedures showed that the haptics actually influenced surgeon behavior.
They applied less force.
Exactly. Median instrument tip forces decreased, with about a 20% reduction in peak force when the feedback was on a medium or high setting.
And that's the crucial first step. You prove the system helps surgeons be gentler. The next step, and management was clear about this, is connecting that lower force to better patient outcomes.
Like faster recovery of bowel function or better outcomes in prostatectomies.
Precisely. That clinical proof will be the next major commercial catalyst for the da Vinci 5.
Okay, let's pivot to the financials now, because this is where the market really found its relief. The margin outlook.
Yeah, the margin pressure that was plaguing them is clearly easing up. The non-GAAP gross margin outlook for the full year was raised to between 67 and 67.5%.
And that 67% mark is so critical. Why were they able to boost it?
Two main drivers. First, better leverage of fixed costs from all those procedures. But second, and maybe more impactful for investors, was the easing of that tariff headwind.
I remember that being a big concern.
It was. The drag from tariffs was supposed to be about 1% of revenue. They brought that down to just 0.7%.
That may not sound like a lot, but for a company this size, reducing a cost headwind by 30 basis points is a massive swing to the bottom line.
The market definitely saw that. And this all comes back to the beauty of their model, recurring revenue.
Right. That segment instruments, accessories, service grew 21%. It's now a staggering 85% of total revenue.
That 85% figure is what provides durability. It means 85 cents of every dollar is highly predictable.
And you can see it in the numbers. Instrument and accessory revenue tracked perfectly with that 20% procedure growth, hitting $1.5 billion.
And service revenue per system was also up 5%, which reflects that higher mix of da Vinci 5 systems, which carry a higher lease revenue. It's a compounding machine.
And on top of all that, a clear signal of confidence from management.
A very clear signal. They repurchased 4 million shares for about $1.92 billion during the quarter. That tells you management thinks their own stock is undervalued.
Okay, let's zoom out to the investor context and strategic roadmap. Management raised the full-year procedure growth guidance to between 17 and 17.5%.
The classic beat and raise. It just confirms they expect this momentum to continue.
A critical piece of strategy they discussed was the plan for retiring systems, the refurbished G strategy.
Right. This is directly tied to the da Vinci 5 upgrade cycle. They had 141 trade-in transactions in Q3. A year ago, that number was just 38.
So they have a lot of older, perfectly functional units coming back to them.
And they've already sold 20 of them. The plan is to offer these refurbished Qi systems as a strategic part of the portfolio, targeting cost-sensitive sites.
Like U.S. ambulatory surgery centers or ASCs.
Exactly. And we need to be clear about ASCs. They are highly, highly sensitive to capital cost. Management was explicit. The biggest barrier for ASC adoption is the upfront cost of the robot, not the instrument costs.
So selling a refurbished Qi is basically a new market entry strategy. It gets them in the door.
It's a brilliant market segmentation play. And ASC was probably not going to buy a full-price da Vinci 5 anyway. This gets them into the intuitive ecosystem, locks in that recurring instrument revenue, and keeps a competitor out.
It monetizes retired assets while defending their market share. That's a smart move.
It is. Now, to be impartial, they did cite a couple of headwinds in the Q&A.
First was China.
Right. Still constrained and competitive market, slow tenders, a clear preference for domestic players. It limits their opportunity there for now.
In second, U.S. bariatric procedures. Weight loss surgery continues to decline, likely because of the GLP-1 drugs.
Yeah, declining at a high single-digit rate.
Yeah.
But they were quick to point out that this is now less than 3% of their total U.S. procedures, so the overall drag is pretty minimal.
Got it. And one last strategic note, the plan to go direct in a few key European countries.
Yes, in 2026, they're switching from a distributor model to a direct sales model in Italy, Spain, and Portugal. They expect that to be slightly accretive to EPS, so they'll capture more of that value themselves.
Okay. That paints a really comprehensive picture of accelerating growth and some very smart strategic execution.
A quarter that really reset the bar.
All right, now for our segment that is definitely, emphatically not financial advice, this is just an entertaining thought experiment.
Here is our outrageous but plausible trade idea built right on top of this report. The market just revalued Intuitive as a high-growth company based on that DV5 upgrade cycle.
At the same time, you have management's confidence with that massive share buyback, but the really big strategic idea is that dual fleet strategy.
Exactly. High-end DV5 adoption for efficiency and the older She fleet being monetized to penetrate new markets like ASCs.
So the proposal is a synthetic long position. It bets on two things happening at once: continued procedure acceleration and the successful monetization of that older She fleet.
The idea would be to short a diversified medtech ETF, something like the Healthcare Select Sector SPDR Fund, XLV, and then go long Intuitive.
So you're betting that Intuitive's specific robotics growth story will separate it even further from the slower, broader medtech sector.
And you're capitalizing specifically on that new channel expansion into ASCs with the refurbished systems.
It's a compelling idea. But again, remember, this is purely for informational purposes, not advice.
To recap, the massive beat was driven by three connected factors: that sustained procedure momentum, the acceleration of high-value Da Vinci 5 adoption, and that significantly improved margin outlook.
So what does this all mean for the future? Management mentioned they're investing R&D, where their core capabilities, robotics, imaging, AI, intersect with big unmet needs. And they specifically called out cardiac surgery.
Which raises an important question for you, the listener, to think about. Given what we've seen with Ion in lung and SP in deep access surgery, which adjacent high-value procedure space will be the next major platform launch for them?
A truly provocative thought. Thank you for joining us for this deep dive into the Intuitive Surgical earnings call. We encourage you to consider the material we covered today as you continue your own research.
We'll talk to you next time.